Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. You've seen this argument online. Somebody starts a new version of it every couple of weeks. Investors going back and forth about Kansas City. Half of them say KC is a 4% cap rate market and the math is broken at today's rates. The other half are claiming they're closing 8% cap deals in KC every quarter. Hundreds of comments deep. Nobody convinces anybody. The thread eventually dies and somebody starts the next one. Here's the thing. They're both right. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. The reason that argument has never been settled is that nobody has the line items at the county level. Today I do. There are also 12 states right now actively trying to limit or eliminate property tax. Indiana, Texas, North Dakota, Florida. And they're not doing that because property tax is small. Every podcast in 2026 is going to tell you Cleveland, Birmingham, Kansas City, right metros, wrong altitude. I'm going to settle that argument with one episode, one metro, 2 counties, every number on the screen, every single one of them computed from public federal sources you can pull yourself in 10 minutes, and a $30,000 a year cash flow gap on the same metro that nobody is showing you because nobody has done the math yet. Let's get into it. The Metro Proxy Trap, pull up the Kansas City Metro on reiprime.com. Go ahead, do it now. If you're at a desk, you'll see a number called the Cap Rate Proxy, 3.99%, almost exactly 4. Tier 2 Hidden Gem, hot score 52.8 out of 100. HUD Fair Market Rent for a 2-bedroom, $1,358 a month. Median home value across the Metro, $265,400. That 4% is what most investors stop at. They see 4, they say doesn't pencil at 6.5% rates, they move on. That's the trap. Here's what the 4% actually is. It's the average across 14 counties, 9 in Missouri, 5 in Kansas. Mean of the population, not the deal you're going to buy. And when you average 14 counties, you wash out the entire story underneath. The best county in Kansas City for net cap rate is Caldwell County, Missouri. Net cap rate, 7.79%. The worst is Johnson County, Kansas. Net cap rate, 2.43%. Same metro, same renters, same HUD Fair Market Rent, same mortgage rate, more than 3 times the spread on the cap rate, and a $30,000 a year cash flow gap on the same duplex math. I'm calling this the Metro Proxy Trap. The proxy isn't wrong, it's just the wrong altitude. The Metro Proxy tells you where the renters are. The county data tells you whether the deal actually works. And it's not a Kansas City quirk. Cleveland Metro, even the best Cleveland County, Cuyahoga, where the city actually sits, nets 4.58% at today's rates. That's below your mortgage. Negative leverage. The best Cleveland County loses you $165 a month before the tenant even moves in. Birmingham Metro, the best county is rural Bibb at 9.27% because Alabama property tax in Bibb is $271 a year. Total. The county tax map is the deal map. Today I give you the line item so you can see how the 4% average becomes a 3 times spread. 2 counties, same metro, watch what happens. 2 duplexes, every number. 1 rentable side of each duplex. 1 unit, 1 tenant, 1 rent check. Multiply by 2 for the full duplex. Every input I'm about to read comes from 3 public federal sources: HUD for the rent, Census ACS for the price and property tax, NAIC, state average for insurance, plus an 8% vacancy reserve, the underwriting industry standard, public data, public math, 10 minutes in a spreadsheet, Caldwell County, Missouri, 50 minutes northeast of downtown KC Polo, Cowgill, country, median property value, $156,700, annual gross rent at HUD FMR, $16,296, property tax, ACS, $1,230 a year, Missouri rural, low millage, insurance, Missouri NAIC state average, $1,549, vacancy at 8%, $1,304, total operating expenses, $4,083, NOI, $12,213. Net cap rate, 7.79%. Expense ratio, 25%. Now run the financing. 25% down, $39,000 cash. Loan, $117,500. Principal and interest at 6.46, $740 a month. Annual debt service, $88.77. Annual cash flow per unit, $3,336. That's $278 a month in your pocket. DSCR 1.38. The bank says yes. Cash on cash 8.5%. That deal works. No rate cut needed. No appreciation thesis. Rent collected. Expenses paid. Money left over. Now switch counties. Johnson County, Kansas. Overland Park. The wealthy KC suburbs. 30 minutes from Caldwell. Different planet for an investor. Median value, $366,000. More than double Caldwell. Same gross rent, $16,296. HUD does not care which side of the metro line you're on. Property tax, $42.21 a year, $352 a month. Insurance, Kansas NAIC, $1875. Vacancy at 8%, same $1304. Total expenses, $7,400. NOI, $88.96. Net cap rate, 2.43%. Expense ratio, 45%. Run the financing, 25% down, $91,500 cash. Loan, $274,500. P&I, $1,728 a month. Annual debt service, $20,734. NOI, $88.96. Annual cash flow, negative $11,837, $986 a month out of your pocket every month, fully rented. DSCR, 0.43. The bank says no, period. That's not a deal. That's a donation. $12,000 a year, while a fully rented property eats your other portfolio's cash flow alive. Same metro, same renter, same week's listings. Caldwell puts $3,300 a year per unit in your pocket. Johnson takes $12,000 out, multiply by 2 for the full duplex, a $30,348 annual cash flow swing. Same metro, 2 counties, $30,000 apart. The framework, the county floor, the net cap rate of the best county in your target metro. Not the proxy, not the average. The actual deployable floor. If your county floor doesn't beat your mortgage rate, the metro doesn't matter. At today's 6.46%, only 2 counties across the entire Tier 2 Trinity still cash flow positive: Bibb County, Alabama, and Caldwell County, Missouri. 2. That's the deployable universe today. Look, if you already own in Johnson County or Cuyahoga or any wealthy suburb across these metros, don't sell. The structural rental demand we covered in episode 116 is real. Rents catch up. Your numbers will improve. Hold. This episode is for the next deal, not the one you already did. And if you bought into the Tier 2 Trinity from episode 112, your thesis isn't broken. I quoted gross cap rates that episode. Cleveland, Birmingham, KC are still the answer. Today is the county layer underneath, the layer the data didn't support 6 months ago. 2 episodes ago in episode 121, I gave you the 3-number screen. Episode 122, builder rate buydowns at 99 basis points. Today, county floor. Stack all 3. The screen filters listings, the builders give you financing, the county gates, whether the math actually closes, and nothing. No rate cut, no buy down, no creative financing. Saves you from buying in a county where the bottom line math is already broken. Your challenge today: pull 3 free downloads, HUD Fair Market Rent for your target metro from huduser.gov. The ACS county profiles from census.gov, median home value and median real estate taxes for every county in that metro, and your state's average homeowner's insurance from III.org. Plug them into a spreadsheet with 8% vacancy. Highest NOI wins. That's your county floor county. Run 3 listings through the episode 121 screen this week. It's only in that county. The full methodology page goes up on reprime.com/markets/methodology/county cap rate this week. Every line item, every citation, every formula, public data, public math. Then what? Go look at 1 listing in person. 1. Don't analyze 50. Walk it. Take the foundation, the roof, the tenant story back to the spreadsheet and either commit or pass. The county already did the heavy lifting. Next episode, episode 124. Manage phase. The tenant screening playbook for the people who'll actually pay your county's real cap rate. Don't miss it. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.